If you've been looking to buy a home in 2021, you've likely struggled. Either there is nothing available, or what you see is going for $100,000 over asking. As a fellow home buyer looking to purchase my second multifamily investment property, I feel your pain. So in this video, we're addressing the question that everyone is asking. Are we in another housing bubble? And more importantly, how can you go about buying a home in this environment? Cool? All right. Tap that thumb icon to spread the good word, subscribe if you like, and let's dive in. To understand whether or not we're in a bubble, let's first clarify on what exactly is a bubble. Economists define a bubble as a situation in which an asset's price departs from its fundamental value. So within the housing market, a home's fundamental price might be dictated by things such as whether or not this is a good school district, proximity to jobs, the architecture of the home, the square footage of the home, and those are just some of the examples. In addition, they're influenced by factors such as supply and demand. If a really good school district has a low supply of homes, then naturally those prices would go up. So now that we understand the fundamental price of a home, it's not hard to understand why homes in places like San Francisco, New York, or Boston have seen long-run price growth. And as prices go up, it's not necessarily a bad thing. In fact, real estate typically will beat inflation year on year. The issue really is when prices start outweighing their fundamentals. So it's always important to try to go back to what are the fundamental values of that underlying asset. And in 2007 to 2009, unfortunately, there was way big of a departure in the fundamentals. You had a tech boom, finance boom, and with these booms, there were high-paying jobs that started attracting more and more people. As more and more people came, the demand for housing increased. With the demand for housing going up and a relatively limited supply, prices also increased. People started getting more and more confident in the price of homes. In fact, they became overly confident. Builders started building way too many homes. The long and short of it was a giant bubble formed that went boop. We can sit here going back and forth on what exactly caused the bubble, right? There was the whole thing with the mortgage-backed securities and getting wrapped into AAA rated funds, but we won't go there in this particular video. It's just an example of what happens when investors get overly confident and drive up the price to a level that isn't sustained by the underlying fundamental value. In the aftermath of the 2008 bubble was a crash of about 60% on average in home prices. Now that we understand what exactly is a bubble, let's examine today's housing market to determine, are we in one? The most important thing to keep in mind is high prices do not mean bubble. Remember, bubble means prices departing from the underlying fundamental value. So unfortunately, if the value is up, prices could be up. Just a thing to consider. The first point we want to examine are interest rates. Interest rates, I would say, are one of the largest determinants as far as how much of a loan you're going to get. The difference between a 2% rate and a 4% rate could mean hundreds of thousands of dollars in costs. And so, with a lower interest rate, folks are typically inclined to borrow more. Interest rates are an all-time low. Pretty much since the pandemic kicked off, interest rates have been dropped in order to go ahead and spur on the economy. People have now gone out and gotten much larger loans because they're so low. A couple months back, we pulled a 30-year fixed pre-approval at 2.25%. That number, to put in context, is pretty much where inflation is. So if you're getting an interest rate that is matching inflation, then you're essentially given free money, which would really spur people to borrow more and more. The reason that's an issue though, when people borrow more, they might go and bid a higher price. Instead of getting a loan for $550, they might get one for $600. And so instead of offering for a max price at $550, they'll offer for a max price at $600. And by offering at a higher price, naturally, the price would go up. What is a positive indicator though is that we are starting to come out of the pandemic economy. In fact, the economy has been roaring. Stock prices are an all-time high. Gears are really starting to turn. And so now we're seeing an announcement from the Federal Reserve that they want to start slowly raising interest rates. To an extent, that will be helpful to the housing market because with higher interest rates, it might make borrowers less inclined to borrow more, therefore helping control a little bit as to what they're offering and potentially manage what that price is. The other thing to take a look at are material costs. The price of lumber last year absolutely skyrocketed. At one point, it was up over 100% year over year. It was pretty complicated as to why, but the long and short of it is when materials that go into building homes go up, the home prices themselves go up. About 4 months ago, if you were driving around with a 2x4, you were a very wealthy individual. What's great though is lumber prices have now plummeted over 70% from their all-time high. Of course, it has a little bit more ways to go if we want to reach pre-pandemic levels. Nonetheless, they are coming down, and hopefully we'll start seeing a reprieve from those inflated prices. Next, let's consider inventory. The total number of available homes is going to be a huge determinant as to what the price is. If everybody wants a home and there's not enough homes, then naturally, as we mentioned earlier, price goes up. And we've had an inventory shortage in the United States really for the good half of a decade now. Part of it has to do with the learnings from the last crash. Home builders got a little rattled and they haven't been aggressively building, which works out for them, right? They want to protect their amount of risk exposure in case there's another turndown. Unfortunately, in this instance, because we already had a shortage of homes and there's been such an increase in demand for homes, that further exacerbated that pricing discrepancy due to a limited supply. The shortage that we've seen has been anywhere from 5.5 to 6.8 million total available single-family homes. Though what's a positive signal is that the monthly available inventory of homes is starting to slowly creep up to match around pre-pandemic levels. And the last thing to consider, the one that I find the most interesting, is the fact that these past 12 to 16 months have fundamentally changed people's perception to work, meaning they don't feel tied to going into an office because more and more companies now are allowing for either a hybrid or a completely remote working environment. In addition, when they're looking for these places, they're looking for larger places that they could have an office. And that's typically hard to come by in metro areas, so they're going to suburbs. As a result of this huge demand and shift away from city centers, well, naturally, those home prices would go up. We mentioned earlier, supply versus demand. There's a huge demand to get out of cities and going into larger single-family homes. And the supply, from an inventory standpoint, isn't quite there yet. And so in that case, we're seeing an increase in the price. As far as when that might cool off, who knows? Maybe this is it. This could be our new future when it comes to working from home or a hybrid work model. Looking at all these factors, it's probably not what you were hoping to hear. You likely were hoping that I would say, yes, it's a bubble, it's gonna pop, and in 2 to 3 months, you can pick up for homes on the dime. But looking at all those fundamental factors, I'm seeing interest rates start to creep up slowly, which is great. Material costs are coming down, which is also gonna help with price. But at the same time, we're still at a national shortage of homes. In addition, this past 12 to 16 months have changed how companies are expecting their employees to work and as far as where they can live. Taking all that into consideration, I think that this is gonna be our quote unquote new normal. I know I hate saying that phrase, but truthfully, this might just be what it is going forward. And so the next question is, what can you do about it? Here are 5 things you need to keep in mind when you're purchasing a home in this current environment. The first, whether you are a first-time home buyer or an investor, time in the market will always beat timing the market. Now, of course, with real estate, if you're getting at the tippy top and that thing goes 60% peak to trough, that's tough to stomach. But the next couple of points will help put that at ease. When it comes to real estate, in the long term, it is an appreciating asset. It beats out inflation for sure, and in the right markets, you're beating the S&P. So I will say time in the market is always gonna supersede trying to time the market. 2, how much home can you afford? The general rule of thumb is you should only be putting anywhere from 20 to 30% of your monthly income toward housing prices. So you need to figure out with your lender, not just what you're approved for, because you could always be approved for a figure that might be 50% of your monthly income, but really what you're approved for and what you should be able to or could afford. Those are 2 very different numbers, because if you start stretching yourself thin and you think, hey, we still might be in a bubble, then you might be in a tight spot if in fact that were true and the bubble were to burst. On the flip side, even if we aren't in a bubble, you still should not be borrowing and trying to expend more than 50% of your monthly take-home income on a mortgage. Third, plan for the worst. What is the backup? Typically, people say have about 6 months of reserve in order to cover yourself if you were to ever lose your job. But I would say in addition to that, from a real estate perspective, whether you're a first-time home buyer or an investor, what can you do to mitigate any type of disaster or downturn? Are roommates an option? You could potentially house hack, where you live in a home, but you also have roommates that are subsidizing your mortgage. Or if you're an investor, buy a multifamily unit, such as the one that I have, and rent out the upstairs. So if you were to ever lose your job, God forbid, your monthly obligations might only be $400 to $500 a month, which makes it a lot easier to save having a 6-month reserve. Fourth, this one's a little bit more specific to the real estate investors out there, but nonetheless, I think everyone should be aware of this program. It's called Section 8. It's a federally backed program in which they help individuals who are in tough financial situations find housing. How it works is, the tenant pays you 30% of their monthly income to rent. The government covers the rest. Now, what's amazing though is, if a tenant were to lose their job, which is not a good situation, but if they were to lose their job, unlike a tenant that doesn't have Section 8, the housing authority that issues the voucher will actually cover 100% of the rent. Let me repeat that. If a tenant, let's say was paying you $200 a month, were to lose their job, they would start paying you nothing. But the housing authority would pay the entirety of that rent. I personally think Section 8 is one of the best recession hedges out there, because quite literally, if every one of your tenants lost their job and they were on Section 8, the government would pay 100% of your rent roll. In addition, with Section 8, sometimes the rent roll is actually better than the market rent. There are areas where Section 8 pays $3,000 a month for a 3-bedroom, but the market rent is really only around $2,700. So that's just an added bonus when you're working with the Section 8 program. And the fifth thing to consider is locking in your rate. Get a 30-year fixed mortgage, because you're locking in that rate for 30 years so that you can appropriately plan for that expense. With adjustable rates, yeah, they might seem better upfront, lower rates and you can adjust, but you don't want to deal with that variability, especially if we go into any sort of downturn and you don't have control over what your monthly home payments are. And you can adequately plan for those expenses. And of course, to save the 6-month reserve that we mentioned, that's much easier when you understand your fixed expenses per month. This has been a great video. I appreciate you tuning in. Please let me know in the comment section below. Are you looking to buy a home? Have you bought a home and are you considering refinancing? Personally, I've had such a struggle trying to find a multifamily home. Things are coming and going, but I'm fully confident in my underwriting, so I have no issues making an offer over asking. It's just a matter of finding the right properties. So if you know anyone that's selling in the Boston market, let me know. My name is John, and I will catch y'all next time. Peace.